Right now, an explosive stock market rally is speeding directly toward a mathematical warning sign that's been accurate for 150 years. It's easy to see why investors are euphoric. Major indexes have been delivering double-digit annualized returns, and that level of continuous, aggressive growth alters what people expect from the economy. A massive part of that momentum comes from artificial intelligence and quantum computing. Analysts project these technologies will unlock trillions of dollars in global economic value over the next decade. Add to that the sweeping legislative tax cuts that permanently lowered corporate rates from 35% down to 21%. That extra cash allowed companies to execute stock buybacks on a scale that reached $1 trillion in a single year. The combination of revolutionary technology and historically low corporate taxes has created a nationwide illusion of absolute market invincibility. That momentum acts like a vacuum. Millions of retail investors are watching their peers get rich, and the intense psychological fear of missing out drives them to pour their savings into equities, even as prices hit all-time highs. But if you step away from the public euphoria and listen to financial analysts, you hear a different story. There is a growing, quiet skepticism that this parabolic climb is historically unsustainable. Crucial historical context gets actively ignored when immediate short-term profits feel this good to the public. The greatest threat to modern investors is a collective, willful blindness to the inevitable laws of financial gravity. To understand that gravity, we have to look at a specific metric that cuts straight through the market hype: the cyclically adjusted PE ratio, or CAPE ratio. It calculates the market's valuation using average inflation-adjusted earnings from the past 10 years, and it is back-tested all the way to 1871. This chart shows the CAPE ratio over the last 155 years. Across all of that recorded data, the safe, historical average valuation for the market has rested steadily at exactly 17.36. For the past several months, however, this exact same ratio has been hovering around an extreme multiple of 40. Historically, every time this metric has crossed a multiple of 30, it has been followed by massive market declines, ranging from 20 to nearly 90%. Crossing this deep red valuation threshold has historically been an accurate precursor to a severe market crash, aligning the current economy with a well-documented pattern of failure. And the timeline for that collision is rapidly accelerating, thanks to a series of compounding, real-world global pressures. Unresolved geopolitical tensions and vital strait closures are squeezing supply chains, directly driving fuel prices higher and reigniting widespread inflation fears. That persistent inflation forces the central bank to keep interest rates elevated, enforcing high borrowing costs that slowly crush the average consumer. At the exact same time, a sudden vulnerability is appearing directly inside the stock rally itself. Foundational artificial intelligence companies are now struggling to actually hit their massive revenue targets. Add to that the lurking, untested threat of private credit. The complete lack of a recent credit downturn is masking elevated risks that could trigger sudden investor panic at any moment. Beneath the pristine surface of all-time highs, a perfect storm of expensive debt, energy shocks, and underperforming tech is actively fracturing the market's foundation. This 150-year valuation data functions as a highly strategic early warning system for the prepared and vigilant investor. Effective preparation requires shifting from an emotional trading mindset to a rational, defensive posture that prioritizes protection over trying to time the market's exact movements. While the general public remains completely reactive to every sudden drop, the informed investor sees the storm coming and calmly prepares. Surviving a historical market correction requires treating the impending drop as a precise blueprint for preparation, rather than a reason for fear. The first step is to aggressively stress test your current portfolio. You need to strip away exposure to overhyped tech trends that still lack proven long-term profitability. Second, build a robust defensive buffer of liquid capital. Readily available cash on hand insulates you against sudden spikes in living expenses and potential shocks in the private credit market. Finally, actively block out the daily noise of volatile market fluctuations to maintain strict strategic focus over the coming months. When the inevitable correction finally hits, the panicked lose everything, but the prepared are given a historic opportunity to buy the future at a massive discount.